Warren Buffett's annual letters to shareholders are the stuff of legend. They're just packed with clarity and wisdom. But the one from 1994, it's really something special. It's a masterclass in how to think about business and value, written right at the peak of his company's power. So let's dig into this letter and uncover the core playbook from one of the greatest investors of all time.
Okay, first, to really get the weight of this letter, you have to understand this one number: 23%. By 1994, Berkshire Hathaway had pulled off something that was, well, almost unbelievable. For 30 years straight, its book value per share had grown at a staggering 23% a year. It was a wealth creation machine like nothing the world had ever seen.
But then, right in that same letter, Buffett drops a bombshell. He says, flat out, that this legendary run is over. And that right there sets up the central question of this whole letter. Why would the guy who built this incredible machine declare that its best days were already behind it?
And he gives you the answer directly. A fat wallet, he says, is the enemy of superior results. See, Berkshire had just gotten so massive, we're talking nearly $12 billion in net worth, that its world of potential investments had shrunk like crazy. To make any real difference, they could only look at deals worth $100 million or more. That meant thousands of smaller, potentially amazing opportunities were just off the table.
This is what you could call the billion-dollar problem. The company's own amazing success had become its biggest obstacle. So how on earth did Buffett plan to deal with that? Well, the answer lies in 3 core lessons that are just as powerful today as they were back then.
And lesson number 1 for navigating this problem is all about perspective. It's about learning to see the value that doesn't just jump out at you from a balance sheet.
Buffett's true north has always been this one concept: intrinsic value. Now, what's so important to get about this is that it's not some hard number you can just look up in an annual report. No way. It's an estimate, right? It's a thoughtful but crucial calculation of all the cash a business is going to spit out for its owners over its entire life.
This is totally different from book value, which is really just an accounting number based on what things cost in the past. Here's a simple way to think about it. Book value is what a company has on paper. Intrinsic value is what a company can do for you in the future. One looks backwards, the other's all about the economic reality of what's to come.
And Buffett gives this brilliant analogy to make it crystal clear. Think about a college education. The cost, tuition, books, all that, that's its book value. But its intrinsic value, that's the extra cash you'll earn over your entire career because you have that degree. One number is simple to calculate, but the other one, that's the one that really, truly matters.
And just to prove this isn't some abstract theory, Buffett walks us right through a real-world example: Berkshire's purchase of the Scott Fetzer Company. This was a whole collection of businesses, including things like World Book encyclopedias and Kirby vacuums.
Just look at these numbers for a second. Between 1986 and 1994, Scott Fetzer's yearly earnings almost doubled, going from about $40 million to nearly $80 million bucks. But its book value? It barely moved at all. So here's the key takeaway. The company was becoming way more profitable, its intrinsic value was shooting through the roof, even while its accounting value was just sitting there.
So once you start focusing on that underlying economic reality, it leads you straight to the second big lesson. If you're going to focus on intrinsic value, you absolutely have to be willing to play the long game.
Buffett loves to use this quote from the legendary baseball player Ted Williams, and it makes such a powerful point about discipline. A great hitter doesn't just swing at every single pitch. They wait. They wait for that perfect pitch right in their happy zone. For an investor, that means having the patience to sit on your hands and wait for a great business at a fair price, instead of chasing mediocre ideas just because you're bored.
And he follows it up immediately with this classic from the hockey great Wayne Gretzky. So, see, it's not just about patience, it's also about foresight. You can't just look at what a business is earning today. The real question is, where are those earnings going to be in 5, 10, or even 20 years? So how does this all come together in practice? Well, it boils down to these core rules. You tune out all the noise, the political forecasts, the economic predictions. You focus like a laser on the long-term economics of a business. You start seeing market fear not as a danger, but as a massive opportunity. And you realize that owning a piece of a truly fantastic business is way, way better than owning all of a mediocre one.
But look, owning great companies isn't the whole story. The third lesson from this playbook is all about the people running those companies and how you create rewards that actually make sense and align everybody's interests.
I mean, this is a huge problem in the business world, and so many companies get it wrong. How do you actually design a pay system that makes managers think and act like they own the place? focusing on creating value for the long haul.
And the difference here is just night and day. A typical stock option plan, a lot of the time, it just rewards dumb luck. If the main company's stock goes up because the whole market is booming, the manager gets rich, even if their part of the business did nothing special. The Berkshire way is completely different. Managers get paid based on the results of the specific business they control. They become true partners, sharing in the good times and the bad.
So when you put this all together, what does the Buffett playbook actually look like? Well, it's a philosophy built on pure logic, incredible discipline, and a really deep-seated sense of partnership.
All right, let's just recap the big three one more time. First, you've got to learn to see the invisible economic engine of a business, its intrinsic value. Second, you have to play the long game, waiting for great opportunities and always looking to the future. And third, you create rational pace systems that turn your managers into real partners.
And you know what the foundation of that whole partnership is? Transparency. In the letter, Buffett openly talks about his mistake du jour, a huge self-inflicted error he made buying U.S. Air stock. He takes all the blame and explains exactly where his thinking went wrong. That kind of brutal honesty, that's the ultimate proof that he sees his shareholders as genuine partners, not just names on a list.
In the end, everything in this letter, this entire philosophy, it all comes down to this one single, powerful promise. It's a commitment that says it all. We're on a shared journey. Our interests, management and owners, are perfectly aligned. It's such a simple idea, but as this incredible letter proves, it's the foundation for building extraordinary long-term success.